Ever wondered how a private company goes public? Welcome to the fascinating world of initial public offerings, or IPOs. An IPO is the first sale of stock by a company to the public, marking a significant shift from private to public ownership. But why do companies decide to take this leap? Well, there are a few reasons. They might be looking to raise capital for expansion, to fund acquisitions, or to pay off debts. Going public also provides an opportunity for early investors and company employees to monetize their stakes. Now, you may be wondering, how can an everyday investor get involved in an IPO? The process involves keeping a keen eye on announcements and prospectuses from companies and expressing interest through your brokerage account. So, an IPO is the process that transforms a private company into a publicly traded one. Interesting, isn't it? So, how does a company go public? There are several key steps involved in the IPO process. Firstly, a company hires investment banks to handle the IPO. These banks play a crucial role in determining the offering price and facilitating the sale of shares. Next, the company undergoes a rigorous due diligence process. This step is all about ensuring the company's financials are in order and providing transparency to potential investors. It's like a health checkup, but for the company's finances and operations. Then it's time for the company to file a registration statement with the Securities and Exchange Commission, or SEC. This document discloses important details about the company and the IPO. It's essentially the company's report card for everyone to see. Following the registration, the company embarks on a roadshow. This is a series of presentations to potential investors. It's like a grand tour where the company showcases its story and future prospects, trying to drum up investor interest. Once the roadshow is complete, the final offering price is set. This price is based on the investor demand generated during the roadshow. It's the market's way of saying what it thinks the company is worth. Finally, with all the pieces in place, the company lists its shares on a stock exchange. This is the moment when the private company steps into the public spotlight and its shares are available for everyone to trade. And voila, the private company is now a publicly traded entity. But how can you, as an investor, get involved? Now that we understand how an IPO works, you might be wondering, how can I participate? Well, the first step is through a brokerage account. This is your gateway to the stock market, including IPOs. It's like your personal bank account, but for stocks. Keep an eye out for announcements and prospectuses from companies you're interested in. These documents will give you important details about the company and its upcoming IPO. This includes the company's financial performance, its business model, and even the risks involved. Once you've done your homework and decided you want to participate in a specific IPO, the next step is to contact your broker. Express your interest, and they'll guide you through the process. It's like making a reservation for a hot new restaurant. You've got to let them know you want in. There you have it. That's how you can take part in an IPO. But remember, every investment comes with risks. While IPOs can present exciting investment opportunities, they also come with their own set of risks. The allure of high returns can sometimes overshadow the inherent volatility and unpredictability of the stock market. Prices can fluctuate wildly, especially in the early days of trading. It's crucial to conduct comprehensive research about the company, its prospects, and market conditions. Seeking professional financial advice can also provide valuable insights. So that's all about IPOs. Always remember to do your homework before jumping into any investment. Happy investing!